All right, it's Wednesday, June 5th at about 11 p.m. Let's do another update. A lot of things going on in the market. So here's the dollar, and it's been moving lower. Now, relative sentiment in the dollar has been bearish, and so we expected it to resolve lower. We also expected it to resolve lower because if it continued to go higher, that would have caused a lot of problems in the bond market. Interest rates had been going up, and that's not good for the equity market. It's not good for the U.S. fiscal situation. There's an election this year, so the administration obviously wants to get interest rates down, wants to get inflation down, doesn't want bond market volatility. So the way to do that is to weaken the dollar. And as you can see, it's been going down the last few days. It's below the level at which dollar relative sentiment turned bearish. We have the non-farm payrolls report on Friday. We'll probably see a lot of volatility there. Maybe this reverses and starts heading higher again. Or, if it's a weak number, and I think the ADP report today came out on the weak side, and there's a connection between what ADP shows and what NFP typically shows, and if that connection holds, supposedly the NFP report will come in weaker than people expect. So that would probably cause the market to price in more interest rate cuts. They've already started to price in a few more because of weak economic data, which is part of the reason why the dollar's been moving lower. But if they continue to price in more rate cuts, the dollar will probably weaken further. So here's just a quick check on dollar relative sentiment. It has been creeping higher. It's bearish, so it's below 50%. That's bearish. I typically look at it in terms of z-scores, but in order to kind of line it up with how the dollar's performed, the dollar total return here, I've mapped it to 0 to 100, and it's creeping up near the 50% level. Above 50% it would be bullish, and in which case we'd expect the dollar to rise, but it's not there yet. And last week, after 5 consecutive weeks of buying the dollar, the smart money sold the dollar on a relative basis. So the spot relative positioning has started to move lower. It will show up on Friday. I lag the data by a week. It comes out on Friday. You can't really act on it at the time. So this is through June 3rd. June 7th's value this Friday will be as of last Friday, and they had been selling. So this light blue line, which is their spot relative positioning, not the smooth version which I use for dollar relative sentiment, but that light blue line will be a little bit lower this Friday. So even though the blue line is heading towards 43, the underlying positioning is still bearish, and it moved lower last week. So I don't expect dollar relative sentiment to turn bullish in the near term. So we'll see what the smart money did, though, in terms of buying or selling the dollar this week. But I suspect that given what we're seeing in the market, that they'll continue to sell. But we'll have to see on Friday. So this is the 30-year yield, and you can see that last Wednesday, I believe it was, Janet Yellen the Treasury Department started buying back long duration bonds, and the 10-year yield has been down substantially every day since. So it was near 4.75. It's now around 4.45. So it lost 30 basis points in about a week. That's a pretty substantial move. And, Janet Yellen, she knows what she's doing. She was the Fed chair at one time. Every time she opens her mouth and says she's concerned about bond market volatility, or she's concerned about, dollar strength, typically things ease as though there's an injection of liquidity, and stocks tend to rally after she says stuff. So she started the buybacks last week, and interest rates are down. So that corresponds with TLT. It's been moving up. It's had a pretty big return the last 4 or 5 days. But as you can see, it's at this level that we had marked for some reason in the past, although it doesn't look like the market really stopped there at any one time other than this point here. But now we're back at that level, and we'll see if it can push through or if it takes a breather. But again, if the NFP is weak on Friday, you should probably expect to see interest rates come down, the dollar come down. And what's helping that is the fact that, well, let me show you TLT relative sentiment first. So TLT is the 20-year plus bond, so long duration bond. As you can see, the total return starting in January of 2022 has come down to 67, so it's lost 33% from that point in time. That's the total return with dividends included. Composite relative sentiment's been pretty good at calling the direction of TLT the last 2.5 years. So it was bearish here, and TLT moved lower. It got briefly bullish, it went up, then it got bearish again. It took a nosedive, it got bullish, it went up, and then it got bearish and went down. It got bullish and went up, and then it got bearish and went sideways. It got bullish, and it's down a little bit from where it got bullish, but this doesn't factor in today's return. So this is actually of June 3rd, and today's June 5th, and it was up 1% yesterday, and it was up, I think, 1% today, or 70 basis points today. So we'll probably break even on this last bullish call here. And if it continues to rise, it might go into the money. But as you can see, the spot relative positioning is bearish. And that's where this blue line will be heading, unless the smart money starts buying various assets that compose this factor. But I suspect that this blue line within 2 to 4 weeks should potentially be negative. So the rally that we're seeing in long duration bonds might have a shelf life. And, we are in a secular environment driven by high inflation. We have an inflation report coming out next week. Now, if that inflation report is favorable, then bonds probably continue to rally, and we probably see, and everything rally, throughout at least the rest of June and potentially into the remainder of the summer. But if it's unfavorable, then I think a lot of what we've seen in the last few weeks could unwind. Interest rates will probably rise, the dollar will probably rise, and equities might have, probably will have a hard time with that if we have an unfavorable inflation report. At the same time, if equities continue to rise, as they have lately, into next Wednesday's inflation report and Federal Reserve meeting, then you could see a sell the news type of event, even if Powell's dovish, even if the inflation report is favorable. People might take some profits, market might pull back a little bit, but if we do see a favorable inflation report, equities probably would have room to go higher after stabilizing if they do sell off on the news. Now, what's driving, or at least part of what's driving interest rates lower and the dollar lower, is oil. So oil, several months ago when we put this chart together, we drew this channel, and it was probably in February or January, and we said, is this a bear flag? And oil popped its head out on the other side of this, and we thought, oh, maybe not a bear flag, but it's come all the way back down. It went from $88 down to $72. Almost 20% pullback. It's an election year, obviously. They want oil prices down, they want gasoline prices down. They de-escalated, or tried not to escalate, in the Middle East. They haven't really hit, they haven't tried to keep the Red Sea open. They basically kept the lid on the Iran-Israel situation whenever that flared up a month or two ago. And, oil has been coming down. Now, GDP growth in the first quarter was in the, I think, 1.3%. And it's looking like GDP growth for the second quarter was slated to be in the 4s. The Atlanta GDP Now forecast originally had it at 4% something, then that moved down to 2.7, 2.8. Now it's down to, I think, 1.8. So growth might be slowing, which might also be playing a role in oil falling. But it rallied today. It took a nosedive. Vertical ranges tend to get retraced. Oil's choppy. We are in a secular environment where inflation is an issue. You have all kinds of geopolitical rivals that would love to see oil go higher just to squeeze the U.S. So let's see if this gains some footing and rebounds, which could then hinder, rates, what they're doing, and it could also put a little crimp in the equity rally. If we look at commodities, so this was a daily chart of oil. If we look at a weekly chart of commodities, in the big picture, it looks like it could be a cup and handle. And without a doubt, we're in a secular bull market in commodities, so we should expect this to resolve higher Maybe not in the near term, but eventually this should resolve higher. This should go a lot higher than the lid of this cup and handle. And I think commodities will be a strong play for the remainder of the decade. So we might find it, commodities might find their footing here and bounce, but it might take a while too. But I would eventually expect this to resolve. Interestingly, relative sentiment in commodities is bullish currently, but relative sentiment in XLE is bearish. And as you can see, XLE has been moving lower. It's back into this ascending triangle. It hit the trend line here and it bounced a little bit, but still finished down on the day. Now, if relative sentiment in XLE were bullish and it's back in this ascending triangle and it hit that trend line, I think this would be a really strong buy candidate. But because relative sentiment is bearish, it might bounce here because of the technical pattern, but I would be cautious simply because relative sentiment in energy is bearish, and typically when it's bearish, you don't really want to be buying XLE. I mean, XLE hasn't been the greatest investment during the secular bull market from 2010 to 2021. It underperformed greatly. Since 2021, it has outperformed. And it's the best performing sector since the end of 2021. So that weighs in its favor. But typically when relative sentiment in XLE is bearish, you really don't want to touch it. So we'll see how this evolves. But if and when relative sentiment turns bullish in XLE, if it's declined even more than this, I think that would probably be a great time to enter, because from a secular perspective, energy stocks should continue to be the best performers throughout the decade. Here we have silver. So the last time we talked, silver was somewhere around here, and I had these two circles drawn, and I said, okay, well, this will be an interesting place for it to bounce, and if it doesn't bounce there, this would be the next logical place for it to bounce. So it did bounce at that first circle, and it went up, and it kind of made a double top, perhaps. Then it sold off pretty strongly the last several weeks, and last week and a half or so, and it bounced pretty strongly today, and it's bouncing after hours. So it closed a little bit above 30 today, and as I'm speaking, it's at 30.63, so it's up 2% after hours, and it's up another 17 cents from when I took this snapshot. So maybe we see this, maybe this is where it's going to bounce, and maybe we continue higher and putting an even higher high. I think I was looking at some technical pattern, and the measured move looked like silver could possibly go to 33.75, and I thought it was headed there. Whenever it was here at 32.75, I thought, okay, another dollar, maybe that's where it turns. But no, it turned at 32.75. Now it's bouncing again. If it somehow manages to clear this level here, maybe 33.75 would be another place where it would pause a little bit. I've heard people talk about 35 as the next important level, and then after that you get into the 40s, and then after that you get into the all-time high around 48.50. So we'll see how that plays out. If we look at relative sentiment, however, in gold, and this is the same relative sentiment that drives silver, it's currently bullish, but barely. It's at 52%, so it's just barely above 50, but it doesn't necessarily matter the level. It matters whether it's binarily above or below 50, and it's above 50, so that's bullish, but the underlying spot positioning is at 31%, and I believe next week this blue line will fall to meet that gold line below 50%, meaning that gold relative sentiment will turn bearish. This is a composite. It looks at gold relative sentiment, silver relative sentiment, dollar and euro relative sentiment, and the only thing that's so dollar relative sentiment is bearish, which is good for gold, and gold relative sentiment is bullish, which is also good for gold. Silver and euro relative sentiment aren't playing a role at the moment, but gold relative sentiment will turn bearish next week unless there's a massive amount of buying by the smart money this week. I highly doubt that's the case. And let's assume that's not the case, then gold relative sentiment will turn bearish next week, and the positioning landscape will then be unfavorable for gold. I personally wouldn't want to touch it, because once it turns bearish, I would not want to touch it, because if you look at gold here, this is looking like this three peaks in a domed house could potentially play out. So we have three peaks. We come up here. This probably wasn't the left shoulder, but this looks like it could be the left shoulder. Maybe this was the head here. Maybe we're going to form a right shoulder over the next week as dollar relative sentiment turns bearish, and then maybe we come back down here and hit this trend line. That wouldn't be, crazy for that to happen. This trend line is around 21, so by the time it would hit it, it would be close to about 2200, which would be, in this uptrend, would be nearer to where it broke out. That would be a logical place for it to fall to. And I should have had a 200-day moving average on this chart. I didn't, but it would probably be somewhere in that vicinity as well. And so there's a big gap between the price and the 200-day moving average. But if it falls down to this trend line, it would close that gap. It would work off some of the excess sentiment that has been built up because of this large rally, and that would probably get a lot of retail traders who bought late in this rally to have to sell at a loss. The other side of that would be the institutions. They'd be loading up for the next leg higher. So we'll see how that evolves. But yeah, if and when gold relative sentiment turns bearish, I think that it would be somewhat prudent to move to the sidelines of gold. All right, so what do we have here? Okay, here's the NASDAQ. The NASDAQ has been quite interesting. So it's been moving lower. This is a 30-minute chart. Goes back to last week. So it was selling off for much of last week. On Friday, it tanked and just went straight down. And then someone turned on the buy algo and it just went straight up. So you have all this intraday volatility, and this was near the March all-time high. It was having a hard time getting above that, and you're seeing this intraday volatility pick up. That's probably not a good sign when the VIX and the realized volatility on a close-to-close basis is pretty low, but on a high-to-low basis intraday, the volatility is starting to pick up. So I had this big rally, big fall, big rally, and then on Monday did the same thing. Big fall, big rally. And then on Tuesday, it basically tried to sell off again, but it finished higher. And then today it was just, straight ramp for the most part. And this is mainly being driven by NVDA, which we'll talk about. But what I think is happening, and this isn't an original thought, I've seen people allude to this, NVIDIA is in a gamma squeeze. So people are buying calls on NVIDIA. The market makers are selling the calls, and in order to hedge those sold calls, they have to buy the stock. So that's just driving NVIDIA higher, driving it higher, driving it higher. And because it's such a large portion of NASDAQ 100 and the S&P 500, it's now the second largest stock behind Microsoft, and it could potentially surpass it tomorrow if it has another day like today. It was up 5% today. So anyway, that's driving the NASDAQ higher, but most other stocks really aren't participating, and we'll take a look at small caps shortly. But with respect to the gamma squeeze, in August of 2020, the NASDAQ had a month where it was just, seemingly up every day, went vertical. But then when that gamma squeeze ended, you had a big hangover, and the market fell basically back to where that gamma squeeze started. So NVIDIA's gone vertical. The legendary technician Bob Farrell says that things that go vertical don't correct by going sideways. So we should probably see NVIDIA have a large pullback, once it finally peaks in this vertical move. And that will cause the NASDAQ and the S&P 500 to fall substantially. Now, when and where it peaks exactly, I'm not entirely sure. But we'll talk about that in a second. Let's look at the S&P 500. So it came up here, set a new all-time high in March at around 53 and change. It fell into April 19th, and then almost a straight line back up to new marginal highs. It did have this, 2-day down period, but then it ramped. It was up like 10 days in a row, kind of crazy. And it made a marginal new high, and then it started to sell off again last week. So that could have been an indication that this was a false breakout. And when you have a false breakout or a false breakdown, they tend to go pretty swiftly in the other direction. And it did look like this was moving pretty swiftly in the other direction, especially last Friday when the NASDAQ and the S&P both went, vertically lower until 12:30 p.m. and then they shot higher. Now this week it's been rallying essentially because NVDA is rallying and NVIDIA is dragging the NASDAQ and the S&P higher. But here again, it's made a marginal new high. So if that now turns around and sells off again after making, two marginal new highs, but wasn't able to put any distance between itself and those old highs, that could be interpreted as being bearish. Now, so that I would expect that this either continues higher and puts some distance between, these marginal new highs and where it rises to, or it does sell off. I expect a big move in either direction. I don't think it's going to just chop around here at this level. Now we have NFP on Friday, we have the inflation report CPI on Wednesday, and we have the Federal Reserve meeting on Wednesday. So one or all of those things will probably cause enough volatility to move this thing away from this level, whether it's higher or whether it's lower. So we'll see how that plays out. If we look at composite equity relative sentiment, it's neutral bearish. So between 40 and 60, the long-term compound annualized growth rate, when it's in that range between 40 and 60, is 6%. So since 1994, it's annualized at 6% when it's between 40 and 60. But since 2018, it's only annualized 1% when relative sentiment is between 40 and 60. Now, obviously, 6% and 1% isn't Armageddon. It's not like it's annualizing minus 30% or anything like that. It's fairly choppy. Now, the reason why composite equity relative sentiment is below 50 is because survey relative sentiment plus machine learning, which was at 100% in the month of May, was actually 100% in April and March, and for several of the past few months, it's been in the 90s or even 100. It went from 100 to 0. Now, I've written about this in the newsletter. I've talked about this on Twitter, but I'll just reiterate it here. This model, the data goes back to 2003, and so a little bit over 2 decades of data, and only 18 times has a monthly desired equity allocation for this model been less than 10%. And of those 18 times, 12 of them have been negative, and they've been substantially negative. The median return of those 12 times that it was negative was minus 5.5%. So that's a pretty significant monthly pullback. The 6 times where it wasn't negative, of those 6, 4 of them were up less than 1%. So again, not extremely bullish. So 16 out of 18 were less than 1% gain on the month. And the other 2 were fairly substantial. One was 3.5%, one was 7%. The 7% one, it was coming out of the financial crisis. It was sometime in 2010, and I'm not quite sure. I don't remember where the 3.5% return came from. But this has been below, of those 18 occurrences, 3 of them have happened in the last 2 years. One was April of 2022, one was April of 2023, and one was September of 2023. And in April of 2022, the market lost, I think, 9.5%. So again, a big drawdown whenever this model was below 10% in desired allocation. In April of 2023, it was up 0.4%. So that was one of the 4 times where it was positive, but up less than 1%. And then in September of 2023, the market lost, I think, 4.8%. So another fairly big drawdown whenever this model was below 10%. Now it's at 0. So, will the market turn around? Again, it's probably either going to have a big up move. It's probably going to put some distance between where it is now and those, previous all-time highs, or it's potentially going to fall, decently. And again, we have the, anticipated economic data, NFP on Friday, inflation and FOMC next Wednesday. That will probably be driving factor in which way the market ends up resolving. Here we have the NASDAQ versus the Russell 2000. I watch this a lot because my sense, given where valuations are, I don't have any valuation data here, but in the newsletter and on Twitter, I post the aggregate investor allocation to equities, which is forecasting 0.9% annualized returns over the next 10 years. The equity risk premium, the expected equity risk premium is minus 3.7%. Hasn't been that low except during the dot-com bubble. And the aggregate investor allocation to equities itself is at a level that is just shy of the everything bubble level at the end of 2021 and just shy of the dot-com bubble level in 2000. So because valuations are bad, I expect equities to put in a major top and to pull back substantially. And what will probably lead the market down is what's led it up. And that has been the tech stocks, the NASDAQ 100. I believe that AI is a bubble. I think that they're having problems figuring out how to monetize it. They've spent, invested hundreds of billions of dollars in it, but they're having trouble figuring out how to monetize it. So investors might kind of put the brakes on the investment. People might cancel orders for NVDA chips if they can't find, if they can't monetize it. So I think that, I think that's in our future, whether that's next quarter or several quarters from now. I do think that tech will eventually be a big driver of downside. But right now, that's not the case. So this is a channel. This is the ratio of the NASDAQ 100 to the Russell 2000. This channel dates back, I think, to 2018 or so, whenever they reintroduced the Russell 2000 futures. There was a period where there weren't any Russell 2000 futures, but once they reinstituted it, I believe in 2018, this channel essentially has confined it since then, the ratio. And so going into last October, NASDAQ was strongly outperforming the Russell. It hit the top of this channel. Then the market bottomed in late October, took off, as we all know, and the Russell led everything higher. But then coming into this year, they were forecasting 6 or 7 rate cuts, and as the year has progressed, the rate cut expectations have gone way down. So they went from 7 to 0. Now I think they're at 1 or 2. And as that happened, the Russell 2000 started to underperform. But since late January, it again started to outperform, and this ratio started to move lower. But then it kind of stabilized, and it was bouncing around sideways until last week and this week, when the NASDAQ 100 outperformed, I believe, 9 out of 11 days. It was up 6% on a relative basis over that time period, which is a pretty strong move. I mean, here's another example of that happening. And then Thursday and Friday, NVIDIA pulled back, so the Russell recaptured 3% in 2 days. But so far this week, the NASDAQ is up 4% relative to the Russell in just 3 days. And it's up another 16 basis points right now. So, and we're only 1% from the top of this channel. So that might be where this thing finally puts on the brakes and reverses, or, maybe it busts through and we're in a totally different, regime. But I do expect this to work its way lower eventually. I do think that, when that happens, not entirely sure, but I do think that this will be a solid trade where the Russell outperforms NASDAQ for a sustained period of time, and until this thing works its way lower towards the bottom of the channel. We'll have to see how that evolves. This is just the Russell itself, not the ratio. And as you can see with the S&P, it's at new all-time highs, and the NASDAQ also at new all-time highs, although this is a 30-minute chart, so it doesn't really give the full picture. If we go to the Russell 2000, not only is it not at all-time highs, it's not even at the yearly high. So it's really been acting really badly. And that kind of speaks to the fact that breadth has been horrible. As the market has gone to new all-time highs, it's extremely narrow. It's just being led by, a few large cap, mega cap tech stocks, and much of the rest of the market isn't participating. And that's kind of, borne out here by this chart of the Russell 2000. So I guess there are two ways to look at that. One is because we are in a narrow rally, once the things that are driving the market higher roll over, we're heading a lot lower. Another way to look at it is once everything that hasn't been participating catches up, the market then continues to melt up. So we'll have to see how that plays out. But coming into the year, I thought we would rally into the summer, late summer, potentially up to the election, put in a major top, and then that would be it. Recently, a lot of the data has suggested, well, maybe we already have topped and maybe we're rolling over now, but as the market, and I guess, we'll have to see how the economic data comes in Friday and next Wednesday to see what the market's going to do in the near term. But the way it's been acting lately suggests that no, the rally isn't quite over, and that maybe we will get that rally into the middle of the summer or even into the fall before a potential top is put in. And of course, a top doesn't necessarily have to be put in this year. It can be put in next year. I would be shocked if it isn't put in next year at the latest, because if it isn't and the market just continues to rally, valuations will have probably largely surpassed where the dot-com bubble valuations were, which were widely viewed as being ridiculous at the time. And we are starting to see a lot of euphoria. I notice, the bulls are really pounding their chest on Twitter. And so that tends to be indicative of situations where you want to start looking to take the opposite side, or at least, watching for signs that the market might be ready to turn. Here's NVDA. So, this pattern still seems to be valid. We had 3 peaks. We have a domed house here. This is the left shoulder. This looks like it's going to be the head. So originally we weren't clear if this was the left shoulder right here and then this was the head, and then it was going to put in the right shoulder and go lower, or if this was going to be the left shoulder and it was going to go a lot higher. And it looks like that was the way it played out. It's gone a lot higher, but it's gone vertical here. And it will run out of steam at some point. The scale and squeeze will end, and it will probably come back down here and close these gaps and then bounce again, form a right shoulder, and that will probably be the top in the market. Maybe when NVIDIA starts pulling back, everything else starts to rally, the market continues to rally, and then when NVIDIA puts in its right shoulder, that might be when the market tops, and then we roll over, and that's all she wrote. Now, if we look at a log chart for the entire lifetime, this is a monthly chart of NVIDIA for its entire lifetime, we had this first trend line. It had this trajectory, and then in 2015 we took off on this steeper trend line, this higher trajectory, and now we have this even steeper trend line. So this is indicative of a stock that's gone exponential, and those, I've never really seen any that hasn't ended badly. So but the question is, where does this go to? Does it go to 2,000, 3,000, 4,000, 5,000, 1,500? Who knows? But we should be prepared for this to pull back significantly. Now, interestingly, I've mentioned my mother here a few times. She's very into the stock market, and she told me, she said, Raymond, NVIDIA is not going to go down until they have the stock split. And so the stock split is this Friday. Maybe that's the day that NVIDIA pulls back, once they actually split the stock 10-1. And that will be the day of the non-farm payrolls report. So maybe that's when the market, maybe we rally into that, and then maybe we sell off the day that NVIDIA splits. Maybe my mother's right. So we'll have to see. That's all I have. Thanks for watching. If you have any questions, feel free to leave them in the chat. And until next time.